What's up, you guys? My name is Andrew. This is Vince. We are on the Invest. We're going to talk to you about a really interesting question. Should you partner on your first deal and getting involved in real estate? So we're going to talk really briefly about all the benefits of, I need a better marker, of partnering with somebody on a deal. So let's talk about kind of some of the bullet points, right? Well, the first one is you want to look for your cash on cash return. Okay, so cash on cash. Cash is king, right? So Vince, talk to him about maybe a sample scenario of what we're going to get involved with.
Yeah, so this time we're going to give you all the verbiage, what everything means, and we'll kind of go over it. And on this side, we'll actually do a sample scenario. It's actually very close to one we did with one of our partners. Friends, So we'll just do those numbers. So what is cash on cash return is you invested $100,000 in a deal. What do you get back end of the year? That's cash on cash return. So for example,
we'll take 50. Take 50K.
Yeah, we'll take 50K as the. What is happening with these?
Yeah, it's about the angle.
50K of equity you bring to the table.
So we're saying if you're going to invest $50,000, that's going to be the number we're going to work with for this entire video. This just as an example. It could be anything.
We will buy an asset worth 200K with that, right? Using the 50K you just gave us.
That's 25% down, standard.
And then we're going to give you 50% of the deal. So you own 100K of real estate. And that's the deal, right? But for that, we're going to give you a straight return based on the profits, how it works. But usually we pay 6 to 10%. So let's just say 6%.
Being hyper conservative for this video.
So that will be $3,000 per year, or $250 per month. That's what you stand to gain at the super conservative level of 6%, which is what we are paying our partners right now.
Yep. So straight return, pretty easy, very, very conservative, and that basically takes care of your cash on cash return. We're going to go into the rate, the actual rate return later, but for now, let's get into the second item. That is the appreciation. So real estate, one of the greatest things about it is in general, real estate appreciates, and we're averaging about 2%. You can go a little bit lower, a little bit above that, depends on your market, depends on the economy at the time. We're going to go ahead and just kind of say it's 2% as our example for this particular sample deal.
So for simple math, right? So going back to the base, it's $50,000 we invested, or you gave us the money. We bought something for 200K. You own 100K of the value, right, of the asset. So 2% of 100K is considered yours. It's unrealized gain, we say it in the industry. So that'll be $2,000 per year.
Yep.
That's it.
Easy. All right, cool.
Super easy.
Super easy. That's your gain right there. By the way, tenants are put in place on these properties, so you're actually not paying any of that. That's just pure gain from that. All right, so equity pay down. Equity pay down. So now that kind of goes more into what I was just talking about with their tenants paying down the mortgage. Vince, going into equity pay down, what that involves.
So what is equity pay down is, so usually, so when we said you know, we have 50,000, we bought something for 200,000, right? Well, how do we do that? Well, we have to go get a mortgage. So that's a leverage at 75, right? 25 down, 75, we borrow from the bank. So that means that we have to pay the bank every month because they loan us money, 150,000. So for this particular case, since we are splitting it, the half of it is yours, right? So we're just calculating the value for you. So we're just going to do the numbers on half. So assuming it was half of that, which is let's say $75,000. Some of the money every month will be going back to the principal, which will eventually pay off the mortgage, right, in 30 years. So that's about $200 a month, and it comes up to, no, it's actually $100 a month, I think, and then it's like about $1,300 a year. Yeah. So it's let's do 1.3K per year. This is the worst spend ever.
It's gonna do. Cool, and that takes care of equity pay down, and then yeah, that's pretty much it. Awesome. And then finally, the fourth benefit is going to be the, of course, your write-offs, and there's going to be quite a bit of tax benefits in general when it comes to real estate. The tax code is literally written in such a way that it gives anyone who owns real estate a significant advantage. This is why we're doing it. We know the rules of the game, we're just playing the game, and so we're getting all these benefits. And so that helps us to not only make a lot of cash because we're doing the deal right, but with these tax benefits, we don't pay any taxes ever, and neither will our partners, or if you're going to partner with somebody. If you're paying taxes, you're messing it up. You need to fire your CPA. We got a lot to cover on this one. You want to start with depreciation?
Yeah, so actually, let me go into a little bit more details. So maybe you write it down.
Sure.
So when you go into real estate, guys, there's actually three types of investors, they call it in real estate. One will be the passive investor, one will be active, and the third one, we won't touch too much about it today, but it is called real estate professional, right? Why I'm talking about this is the tax benefits of owning real estate is strictly related to this. So if you are a passive investor, any losses, paper loss you accumulate in the real estate can only be used to offset your income that you made passively, bonds and stuff, like. So you can't really use that income. So you will never tick this box. So when you file for taxes, tell your CPA to always tick the active box, right? What does that active box means? That if you lose money in real estate, you can deduct up to $25,000 of your real estate losses on your other side where you make active income. So I make W-2 income. Let's say I make $100,000. I have enough properties that I can claim a loss of $25,000 year after year. Then I cannot pay taxes on the top $25,000 of my income from my W-2 job.
Which also lowers his tax bracket.
It lowers my tax bracket, and he does it too. He has a business too. Yeah. So that's the active. The third one is this. This benefit goes away in the short term if you make more than $150,000, right? So what does that mean? Does that mean that all the stuff you're going to talk about doesn't account to you? No, that doesn't mean that. What it means is you actually start storing it in a bucket and you will hold it for like 10 years. And let's say 10 years later you sell the property, you can actually take it to the table and then say you had a capital gains event of $200,000. And if you had $200,000 accumulated for the 10 years, you will pay no income tax when you sell the property. So that's what that means. That is if you are active, and then if you make more than $150,000 a year. Mm-hmm. The third one is your real estate professional. It's a whole different topic, but it's pretty much you spend most of your time in real estate. That means none of this matters. You can deduct $1 billion of losses. That's why Trump pays $0 in taxes. Yep. So he's a real estate professional.
Yep. Awesome. So let's go and get deeper into the general tax benefits of what you're going to gain here. So depreciation is the first one, right?
Yeah. So let's go into depreciation is the paper loss, which is what it means. So we're doing the numbers on this side, right? So we're going to take. Remember, you own $100,000 of the house is yours, right? So we'll do the math on that. Mm-hmm. So $100,000 is the property value, right? But you can only depreciate a building. You can't depreciate land unless it's a golf course, but that's a different video. Trump. 100K is the property. Let's say 80K is the property value. So if your building is 1 to 4 units, if you bought a single family, a duplex, triplex, or a fourplex, or a quadplex, depending on where you stay that in the country, right? You can depreciate this 80K over 27 and a half years. So how does that work? All you have to do is just take the 80K number, divided it by 27.5 years. What do you get? $2,900. So what this $2,900 is, on your taxes, you can put it that you lost $2,900. Did you lose $2,900? No, you did not lose anything. It's just a paper loss that you say that you lost. So for the 50K, remember, you're paying $3,000 a year, right? I just told you lost $2,900. You pay no income tax on the 3K. Just with that. Just with that. Just one.
Not a real
and we're
loss.
going to talk about like 10,000 different things now. So you want me to go in for the
go for all of them.
So the first one was called depreciation, guys. So this is called depreciation. Depreciation. That's the first one. The second one is so let's say we do insurance. You want to just
Yeah.
tell me what it is?
So these are some of the actual losses, not just the paper losses. So with insurance, what do we got? 600
Insurance, we got
for the year.
600.
Repairs, we just estimated about 1,000. That's reasonable. Maintenance, another 1,000. Management, 800. Miscellaneous, because it's just always something. You know, we're gonna put that at 1,000. You know, we're trying to be hyper conservative here. This is just something that. Here we go. Yeah.
What else
This
we got?
is something that we've been experiencing for a while, and so these are pretty spot on numbers. But
So if you add all of these things together, what do we got? $7,300.
yeah, with the depreciation, 73.
So we got $7,300, right?
Yep.
So this is a loss for you, right? Remember, we already gave you $3,000. Whatever happens here, you don't care because we usually manage it for the people, right? So
Right. So this is not an actual loss either.
So
Right.
this is how much you're losing
Yep.
on paper.
Yep.
So what's next?
And I think we had getting into what was this? I can't read your handwriting at all, brother. Oh, so yeah, because you're actually a business now. When you own real estate, you're officially a business owner, whether you register or not. And so what you're going to be able to do is now you're going to be able to take all these extra tax benefits of what a business owner can write off. That is, you can write off your car, if you have a home office, part of your phone. I've been doing this stuff for years, so I'm really good at it at this point. You can write mileage of your car. Again, you know, this stuff has to be associated with the actual real estate, namely the property itself. So if you're driving to this property back and forth, you're writing those miles off. If you're making calls with something that has to do with that property, you're writing that off. I could go on for days. If you're working from your home on stuff, that's a definite write-off. If you're eating meals out there, you can write those off, I think, up to 50%.
Actually,
But
for
they just changed
2021 and 2022, the IRS changed the rules to 100% of the business meals can be written off.
Which is awesome.
So let's do some quick numbers, guys. So
Yeah.
car, let's say you drive 1,700 miles, 58 cents, 56 cents, whatever the IRS has. Let's just say we drive more. I drive like 5, 6, 10,000. I
Yeah.
write off like $5,000. But for you guys, I'm just going to say
Conservative.
$1,000, right? $1,000.
Mhm.
Phone. You know, you can't write off all of the phone, but let's say you use half the phone for real estate calls and stuff. You can write off half of it. So let's say $600.
Yeah, that's about right. That's what I wrote off.
Okay. Home office is very interesting. Home office is you take your let's say you pay $1,000 or $1,500 in rent,
Right.
and then you just times it by, you could do up to 35%, but let's be conservative, 20% of
Mhm.
your home office, and then you times it by 12, so for the whole year, and then you can write it off as an expense. So part of your rent is covered because you own real estate.
Mm-hmm.
So what does that number come up to? 36.
The
or
home
something?
office, I can't read it. Is that 36?
Yeah, it's 3,600.
Yeah.
We got $3,600. And me also, let's say you eat for a year for $600.
Yeah.
So what's the total here?
I still can't read it. What is that? 5,800?
36 plus 1,000 is 46. 46 plus 1,200, yeah. So we got $5,800 of additional write-offs. So what is the total?
Total was 13,100. I can read that out. Hopefully you guys can read this as well. You know, in post, I'll probably put some numbers as well.
Yeah, you can do that
You
too.
guys stay organized on this.
So, okay, great guys. We just lost $13,000. So what does that really mean? Let's do this is the real stuff, right? The real stuff is what is the final number you're getting, everything, right? So I'm going to put that over here, right?
Mm-hmm.
So we're going to go from the top, guys. Keep up with me, okay? Cash on cash return, COC. What did we get? We gave you 6% on $50,000. Math question. What is it?
Mm-hmm.
$3,000, right? And then I said you lost $13,000, right? Remember, we have to pay income tax, right? You made $3,000, you lost $13,000. So what did you lose? You lose $10,000, right?
It's right at 10.
So hey, so did I just get 10,000? That's not how this works. This is a tax write-off, right? So you're gonna take, let's say you made $100,000 in income, and you're in California getting taxed through their nose, and you're paying 30%. 30% of the $10,000. How did we get 10,000? 13,000 minus 3. You made an income. That's 10,000 in losses, right?
Mm-hmm.
So 10K in losses. So in reality, that comes to about $3,000. If you are a 30% tax bracket, you actually save $3,000. So that's actually money into your pocket. So we can count that as income, right? So 3,000, and you have another 3,000.
3,000.
Then what else do we have? What is this guy? 1.3K.
1.3K.
Oh, okay. So that is. Remember the equity pay down, guys?
Oh,
We paid down 101.3K in the whole year. So that's actually going back into your pocket. It's unrealized. You can't get it out, but it's there.
But it is profit.
Appreciation, $2,000. If it's 100K for a whole year, $2,000, right? And then
add all that up, you got 9.3.
9.3K, guys. How much money did we invest in this deal? $50,000. 9.3 is 18.6% return. So 50K in.
Are you making that in the stock market consistently? 18?
That's
almost 19%. This is hyper conservative. This is like the lowest in.
This is the first year, guys.
Yep.
This is the first year.
That's his first year.
So
this would compound.
So if you do times 10 years, right?
Yeah.
I mean, it compounds, so it's actually more. But if
Right.
you just whatever, if you do the basic stuff, you're looking at 93K in profit.
In 10 years. And again, it's hyper conservative. It's not including the actual compounding of that number. We're just trying to keep it real simple. Bottom of the numbers, because these numbers get way better, especially with bigger deals, in which you can essentially get more. You would own more of the asset if it's a bigger deal. You go up to the 70% line, in fact. And so take all that and do that with 7%. You got a whole different game happening.
So if you do this by yourself, what is the benefits? You could possibly make more money because you will control 100% of the deal.
Yep.
What is the negative aspect of it? You could lose all of it and go to jail. So, oh, one last point. Bonus point.
Bonus point.
So this deal is based on a 50-50 partnership, right?
Oh, that's right. Yeah, it's important.
This is how this deal works. Technically, the higher the deal goes, let's say we buy something for, I don't know, $5 million, right? We will give you guys, like the equity partners, 70% of the deal. And we will keep 30%, obviously, and then we'll do all the work, right? So that's how that will work.
Absolutely.
Yeah.
So hopefully that helps you to determine whether it is right for you to partner with somebody on your first deal, or just to go heads first and just try it out and figure it out on your own. You can definitely make better returns that way, but you're just taking on a lot more risk. You're starting a new business. It's very time consuming. We definitely got beat up on the first year for sure, but we made it out clean and we've been doing really well ever since. So thank you guys for watching. I hope you guys liked this. If you did, go ahead and like the video, subscribe, share it with your mom, your dog. Everybody needs to watch this freaking video. We want you to win while we win.